or do we just have to throw out the old economic models and accept that maybe, just maybe this time, you're going to have a tight labour market but wages coming off? Is that unbelievable that we could accept that that is potentially what we're looking at?
And listen, there are laws of gravity. Is it possible that you drop an apple and it goes up, not down? I don't know, but that's just not the way things work. If we right now have the JOLTS report said that there are more companies looking for labor. The Thursday weekly claims report said companies are unwilling to let go of workers even if they're not happy with them because they know they can't replace them. And today you see that there's a huge number of additional hires. And interestingly, more people are entering the labor market. The participation rate went up because why? Wages are going up and it's telling people, come on, get a job. You're going to get paid more money. So is it possible that you have a red hot labor market and no inflation? Anything is possible, but it's seeming increasingly improbable.
So, Jonathan, your year-end target for the S&P is 4050 or above that level. So would you be then selling any rallies? And does that apply to, like, tech? Because I think, like, after yesterday with that NASDAQ 100 up 3%, how are you not tempted to chase that?
You know, Alice, our call, if you look at, when we put out our market target in October, what we basically said was that we were going to have a really, really strong rally in the fourth quarter and into the beginning of the year, and that the first half of 2023 was going to be stronger. Why? Because inflation, and I'm not talking about wages here only, but I'm talking about CPI and PPI are falling really rapidly, and consumer confidence has been rising now for 6 months. The Fed is signaling that they're going to pause in March. And all of this is a huge positive story to draw capital into the market. And it did that all of the fourth quarter. And in the last 4 weeks or so, it's not only brought capital in, but it's been much more speculative in nature. Bitcoin going up and speculative companies with no earnings, doing super well. And our take is that ultimately that if the labor market stayed this hot, the Fed was going to have no choice but to disappoint the market later in the year. And we're pretty much on that playbook right now. I mean, is January a bit stronger, or the beginning of February a bit stronger than I had anticipated? Maybe a tad, but the overall outlook is very much in line. Stronger first half of the year, weaker back half as the Fed disappoints.
Okay, so if you have to have exposure to U.S. equities, where is your tilt at this point?
Well, in the very near term, I mean, the other thing which is important here is we're not going to have a recession, or at least we're not going to have a recession in the near term. And if that's the case, you don't need to be in defensive stocks such as staples and utilities and the like. Tech is really doing quite terribly on fundamentals. So while tech companies are ripping on their stock prices, they're having an awful earnings season. And that's true both in terms of their growth rates, massive margin contractions, missing estimates. And so I would love to buy tech. It's just the fundamentals are telling me to stay away.
But Jonathan, then on that point, though, I'm looking at Apple. It's up 3%. Their supply chain commentary and their economics were like really not good. They were weak. The stock was down. Now it's up 3%. How is this making sense?
Well, Alex, what if you look at other times that look just like this historically, it's when you're leaving a recession. You've had a recession, it's over, or you've had a major crisis, 9/11, the financial crisis, whatever it is, and you're now on the other side of it, and you're getting this big V-shaped bounce and liquidities flooding into the market, and you have lots and lots of runway for economic success. The problem is that we're getting this V-shaped kind of bounce, but the earnings are decelerating. The economy is relatively punked. The expectations for GDP for the next couple of quarters are for basically zero, or for only 50 basis points for all of 2023. So if you use the other periods where we've seen this type of leadership as a guide, it just doesn't line up with what we're seeing now. And I think people who chase this are going to get really hurt.
Okay, people are faced with pain. 17% rally in terms of the Nasdaq year to date, and we just have Apple as one example today. Even as Apple, or at least Amazon and Alphabet are off in the session, again, investors digesting those results. Jonathan, when it comes to the squeeze on EPS, when do you expect that to bottom? When do you start to see a little bit more resilience in the earnings per share picture?
So let's focus on what the big issues are, and there's two. The first one is that consumer prices or CPI is falling more than wages are falling, which means companies are getting stuck paying higher wages but not being able to pass that on. So there's a general margin squeeze which is playing out in virtually every sector of the economy. However, there's something much larger going on in the tech space where they meaningfully overhired staff, where the expectations on what would have, the trajectory that we saw during the pandemic, we all extrapolated that, and that's causing a big disappointment there, not only for us as investors, but for the companies themselves. So I think you're going to see really margin weakness throughout the course of the year. The consensus view is that when you get into the third and fourth quarters, we start to exit this type of an environment. It's really hard to be so specific, but our expectation is that we have $215 of earnings this year. The consensus is about $225, and the consensus estimate on earnings is falling like a stone.
Hey, Jonathan, it's really good to catch up. Fun day to talk about it. Jonathan Golub of Credit Suisse. It's good to see you. Speaking of tech, it is 20 past the hour on the West Coast. Let's get to the startup. We cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Ed, let's kind of start where we left off. Apple's up 3%. Sure. What do you think about that?
Yeah, I mean, as Jonathan put it, these stocks, when you look at the fundamentals, are not doing well, and the stock does not reflect that in its trading. I mean, what we learned on Thursday night is that Apple, Amazon, and Alphabet are not immune to macroeconomic headwinds, right? The Apple call in particular is fascinating because Tim Cook was blunt. Their fourth calendar quarter, fiscal first quarter, would have been much better had it not been for this long list of excuses: supply chain constraints, a lack of demand in China. He even went as far as saying that had there not been supply chain constraints in Zhengzhou in the last 3 months of 2022, they would have seen growth in the iPhone segment. The iPhone segment missed estimates and revenue overall dropped 5%. That's quite an astonishing thing to say. The big but, on this earnings call. But, as Apple has not done recently, they haven't given us any forward-looking guidance for this year. So we don't have a lens, really, in terms of how that improves.
Yeah, Ed, the China factor is going to be fascinating, isn't it? I mean, just anecdotally speaking to people on the ground, they are ready to go out and spend, certainly, and they're sitting on many of them savings that have been built up over the last 3 years. So we'll see what that ripple across for Apple is going to be. I'm really interested in your views on what's happening in cloud. We had the warning around Microsoft and Amazon coming out, of course, AWS, so important for that business. What is happening with cloud, Ed?
Yeah, look, AWS was the surprise, right? The commentary was very specific. They see growth decelerating in cloud on an ongoing basis over several quarters. We've gone from a situation where AWS had top-line growth of 40%, and that's dropped pretty dramatically to 20%, which is still significant growth. But the thing is that AWS and Amazon has always accounted for the majority of operating income because the e-commerce business is not as profitable, less than profitable. And so now AWS is not carrying the rest of that business. In the fourth quarter, Amazon actually did very well. Sales grew 9%, came in above expectations. There was sustained demand for at least the e-commerce side of the business. It was the weakness of the outlook that spooked investors. We learned that with Microsoft earlier in the earnings season, right? Azure did very well in the quarter just gone, but in the current period, the commentary is around a pullback in corporate spending when it comes to the transition to the cloud.
If we go to Alphabet for a sec, where do you think the biggest problem was for Alphabet? Because in some ways, like Meta was going to help preview that in terms of the ad market. Clearly, investors were still surprised. Why?
I don't have the answer, but that is my answer. I spoke to Ruth Porat on the phone, okay, and Ruth Porat basically says the underlying results reflect macroeconomic headwinds, particularly in the advertising market, weakness in search, weakness in YouTube. But what was strange is Porat told me on the phone she recognized resilience in search, which was something significant to say when the numbers clearly don't reflect that. There's also the financial impact of the layoffs, right? That they're going to book a charge of $1.9 billion to $2.3 billion. And slow hiring at the same time. Those two ideas seem a bit incongruous to me. But I think the point with Alphabet is that it's tightening its belt and refocusing itself for this year. Looking forward, in the earnings statement, they said there might be additional costs associated with the cost reductions. And I said, does that mean more layoffs will be announced down the road? And she said, no. The majority of the layoffs are happening in the US right now, in the current period. They haven't got to international markets yet. They haven't started notifying those. So when they do that process in Europe and other markets, there might be costs that they haven't foreseen. And then, of course, there's AI. A lot of pressure on them to kind of lift back the curtain. And they've been talking up AI for years, but they don't have anything commercialized to show for it. So analysts were really interested in that on the call too.
Yeah, watching maybe for the DeepMind answer then within Alphabet's ecosystem to the response from ChatGPT. Ed, just on the jobs question, you nod to us, you touch on it. Where are we in terms of cap tech cutting jobs? Are they almost done at this point?
We believe they're done. I think the thing is that when you think about US jobs data, there are various reasons that the layoffs don't show up. There's 155 million jobs in this country, and while the headlines are sensational around tech layoffs, they're a tiny proportion, and we're seeing evidence in other data sets that actually those laid off are finding new jobs quite quickly. But that is the question on what the action the companies take themselves. Are these cuts deep enough? Because I don't think we have the chart to hand, but if you look at the hiring growth over the pandemic era, these cuts do not unwind the growth that those companies saw between 2020 and present day. They became incredibly bloated. These are trims, but they don't reverse the kind of boom in headcount that came with the pandemic and the demand associated with that with consumers. That's what I find interesting.
OK, yeah, really interesting. There is that context then. Ed Ludlow, thank you very much indeed. Coming up, we are going to be getting more, of course, on that jobs surprise, 517,000 non-farm payrolls. We're going to get the takeaways from Daniel Yanis, co-founder and CEO of Checker, and Kathy Bostenchik, who's the chief economist at Nationwide. And we are awaiting President Biden's remarks on the jobs numbers. He'll be stepping up to the podium shortly. This is Bloomberg.
I love your browser history.
You are so generous with your personal data.
Switch on privacy. Switch off trackers and viruses. Go to NordVPN.com. NordVPN. Safely be you.
We're excited to do business with you, but before we sign, I gotta ask. We searched you online, and maybe you can explain this?
Can't believe that garbage is still coming in. That is so false.
Frustrated with your online search results? Call Reputation Defender today to join tens of thousands who've improved their online reputation. Get your free reputation report card at reputationdefender.com or call 1-877-866-8555.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're about an hour into U.S. trading session. Blowout jobs, blowout ISM services, and stocks are only down 0.3%. Abigail's tracking the moves for us. Abigail?
Yeah, this may be a case of good news is good news, because at this point we do have stocks well off the lows earlier. We had that S&P 500 down more than 1%, the same deal for the NASDAQ 100. But at this point, really off of those lows, the feeling that maybe there could be some kind of reversal, despite the fact that you have yields sharply higher on those blowout numbers, the suggestion that the Fed is going to have to stay there at the hiking wheel, and the Bloomberg Dollar Index up 0.8%. Now, one reason for this turnaround, it has to do with two big names, or at least two big names. If we take a look at the shares of Tesla and Apple, we are going to see decent gains. Tesla up 4.3%. This on the announcement that the U.S. is going to be extending those EV tax credits. More vehicles will qualify. So using Tesla as the proxy for this, up 4.3%. But take a look at Apple, up 3.6%. This stock had been down despite the revenue growth decline and a disappointing quarter. Maybe some people looking past that, thinking it has to do with the China weakness from last year having to do with lockdowns, that was sort of a one-time thing and that they'll be back full engines ahead. Well, speaking of full engines ahead, on the week we have stocks higher, and that certainly has to do with some of the big tech stocks. If we take a look at what's happening there, we have Meta Platforms up 24% on the idea that Meta is now investable in and the year of efficiency. Amazon, despite the decline today on a disappointing quarter, up nearly 5% on the week. Alphabet, Nvidia, we have also up sharply. And, of course, this puts the NASDAQ 100 in a good position. If we take a look at what's happening for this chart, here is the downtrend, last year's bear market. And I say last year's bear market because there's significant signs that it's coming to an end. You first of all have the NASDAQ 100 popping above it, breaking it. You have basically almost a bull market here. Now, the RSI is close to overbought or at overbought on a daily basis. But on a weekly and monthly basis, nowhere near, suggesting that even if we were to pause in the near term, which is not clear if it's going to happen, that the buyers, that they are very much behind the scenes. They're wanting to take this big tech index higher, Tom.
Okay, the NASDAQ closing in potentially on that bull market. Bloomberg's Abigail Doolittle, thank you very much. Now, US Labour Secretary Marty Walsh weighed in earlier on the red-hot payrolls data.
I looked at my economist and I said, you were way off today. You know, it was a great report. I mean, when you look at areas that I think are really important, business grew, healthcare grew, education grew. And we saw strong, steady growth in construction. I mean, so those are areas that obviously you would know better than I would as far as signs for the economy and concerns about the economy. But right now, certainly I'll take this jobs report for any day of the week.
Okay, let's get the employment picture then on the ground. We are joined now by Daniel Yanis. He's the co-founder and CEO of Checker. It's a company that helps to onboard employees for companies like Uber and Netflix. Daniel, let's start with you. What you're seeing across your business in terms of the tightness of this labour market. Look, the top line, 517,000 in terms of non-farm payrolls. We can have a look at that. Delve down into the micro, though. The data that you're seeing on a day-to-day basis, how resilient is the job market that you see?
Yes, hi. So, yes, in our data in the different industries, we see very interesting trends in January. So definitely we can confirm that tech companies are having very low hiring volumes, and that aligns with our layoffs and news. So very low January for tech companies, but tech is a very small portion of employment. And so when we look at the other industries, we have a very large base of small and medium-sized businesses. SMBs have had a huge spike in January, so plus 44% increase in hiring volume compared to December. So we can see a huge spike in small businesses, and also similar trends in the gig economy and other parts of employment. So despite the headlines, we see a very high volume of jobs and a big jump in January.
Hey, Daniel, are you seeing any signs of labor hoarding? And if so, what industries?
So really it's in across all industries. There's still a lot of pressure, not enough jobs and not enough people available for jobs. So that's why I think customers and businesses are still fighting for that labor force. So that's a big trend. I think tech is the only exception. and that might be temporary, but every other industry we're seeing is hiring, is fighting for jobs, fighting for workers.
It's really interesting. In terms of when it comes to technology, and within that, we've heard anecdotally people who lose their jobs are very quickly able to pick up their jobs. We're going to cut in at this point, because I believe we have the President. Alex, you're going to throw to this.
I'll be short, because we'll have some good news. Before I head to Philadelphia, I wanted to say a few words about what I think is strikingly good news that we just received. Next week, I'll be reporting on the State of the Union. But today, I'm happy to report that the State of the Union and the state of our economy is strong. We learned this morning that the economy has created 517,000 jobs just last month, more than 500,000 jobs in just the month of January. In addition, we also learned that there are 500,000 more jobs created last year than we thought. So the January report is updated. The December report is updated. Add that all up, it means we've created 12 million jobs since I took office. That means we have created more jobs in 2 years than any presidential term, than any time in 2 years. That's the strongest 2 years of job growth in history by a long shot. As my dad used to say, a job's about a lot more than a paycheck. It's about your dignity. And 12 million more Americans get up every morning knowing they can provide for their families with the dignity and sense of self-worth that had been missing. We also learned that the unemployment rate fell to 3.4%. 3.4%. That's the lowest in 54 years. In fact, the last time unemployment rate was that low was May of 1969. Think about that. And what's more, Black and Hispanic unemployment are near record lows. This matters. More working-age folks coming to the labor market looking for jobs last month than have in a long while. That is, remember all the talk about no one's looking for, we need more people coming into the market. Well, more people are coming into the market looking for jobs and getting jobs. Positive sign for the health of the economy going forward. And even as the job market reaches historic highs, inflation continues to come down. Inflation has now fallen for 6 straight months. Gas prices are down more than $1.50 a gallon since their peak. Food inflation is falling as well. And as inflation is coming down, take-home pay for workers is going up. Real wages are up. Wages for lower-income, middle-income workers have gone up even more. Couple that with a 2.9% economic growth last quarter, and here's where we stand. The strongest job growth in history, the lowest unemployment rate in 54 years, manufacturing rebounding at a faster rate than in the last 40 years, inflation coming down, real wages going up, but moderately going up, not going through the roof, the economy growing at a solid clip. Put simply, I would argue the Biden economic plan is working. For the past 2 years, we've heard a chorus of critics write off my economic plan. They said it's just not possible to grow the economy from the bottom up and the middle out. They said we can't bring back American manufacturing. They said we can't make things in America anymore. That somehow adding jobs was a bad thing. Well, or that the only way to slow down inflation was to destroy jobs. Well, today's data makes crystal clear what I've always known in my gut. These critics and cynics are wrong. While we may face setbacks along the way, and there will be some, there's more work to do, it's clear. Our plan is working because of the grit and resolve of the American worker. We're going to keep lowering costs for families, from lowering costs in health care, prescription drugs, clean energy. Because we passed that legislation, we're going to be rolling it out this whole year. We're going to keep seeing shovels hitting the ground all around the country to rebuild the infrastructure and supply chains, manufacturing more here at home. And in communities across the country that were too easily written off for dead, we're going to not only see jobs coming back, but a sense of self-worth and pride coming back. Nothing worse than when a city has a major manufacturer leave, shut down, and all of a sudden your kid getting out of high school or college says, "Mom, we got to move. Nothing here for me anymore. Nothing here." Well, I'm intent on changing that in the heartland as well. That's how we build an America where we all can take pride in working families have a good jobs and a little more breathing room. And as the economy grows from the bottom up and the middle out, it's my objective for the long haul. Trickle-down economics works for one group of Americans. It doesn't work for everybody. And so this is what it's all about. So I'm heading off to Philadelphia, and if you want to ask me a question about the economy, but I'm not going to answer any question about anything else because you never will cover this.
Mr. President, why did you decide to postpone Secretary Blinken's trip? Could you take any blame for inflation, Mr. President?
Am I taking blame for inflation? No.
Why not?
Because it was already there when I got here, man. Remember what the economy was like when I got here? Jobs were hemorrhaging. Inflation was rising. We weren't manufacturing a damn thing here. We were in real economic difficulty. That's why I don't. Thank you.
Mr. President, when and how will you remain the balloon? When and how will you remain the balloon, Mr. President? You were listening to